What goes up must go down. And in the financial markets, it really works. I have an example in the book. The point of all this, Jim, is don't buy funds on the basis of past performance because it's not going to continue, or it's only the extraordinary case when it's going to continue. So people tend to, as I mentioned earlier, put their money into these big winners, and then down it goes. They pick the high because that's when the fund looks the best. So in that part of my recommendations, recommendation 1, I've taken 8 of the best known and most successful mutual funds of the modern era, and I've charted their return year after year cumulatively against the S&P, the Standard & Poor's 500 index. And every fund looks the same, although all the time periods are different. The fund goes like this, and then it goes like this. This, over and over and over again. And you see this in the big winners of the age, and they go away, their managers leave, even the good managers might get fired, the bad ones retire. There just doesn't seem to be any permanent way to beat the stock market. It's all fads, fashions, particular time periods. You know, when, for example, growth does better than value, you want to put your money in a growth fund, and then value does better than growth. Well, these 10 funds, which I list by name in the book, and 2 of them are Vanguard funds, in fairness. This book is an attempt to be really honest, no matter how painful, and you see that same pattern over and over again. So when you say, I ought to buy this fund, I can tell you where you are on that line, right at the peak. And when the temptation is overwhelming, you put your money in and then are disappointed thereafter. Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years, for today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, is probably 90. So you're going to be, and then you're going to be investing, you know, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you, but
not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend. But if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this. When the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive in buying at the high, your money, inflation, which you have no control over, eats away at the value of your dollars. You may think you're being safe if you buy a bank CD or an equivalent instrument, and let's say over 10 years. But that the instrument's going to lose 30% of its value conservatively over the next 10 years. You know, they'll have a little bit of interest to offset that. But if the dollar is worth 30%, which is roughly 2.5% per year in inflation, that's gone. You've taken a big risk by, in effect, speculating, for the want of a better word, that the dollar will remain unchanged, and it never has. And I don't think in our lifetimes it ever will. Maybe sometime. But so there's the big risk. So when you look at, say, stocks and bonds, stocks at least have a fighting chance to overcome the ravages of inflation. And the way I look at it, I've got some math behind this, because with a dividend yield of stocks about 2%, and potential earnings growth should be in the range of 5%, stocks should give you about 7% over the next 10 years, gross, before cost, before anything. So that's a fairly conservative number, but I think it's realistic. And bonds should probably give you about 2.5%. So if you think about inflation, if there's 2.5% inflation, and the bond gives you 2.5%, you're doing a break-even investment over the next 10 years. And that's just, you need more than that if you're going to build a retirement fund.
And if you have X dollars and you're getting 0%, and you even if you're living frugally, you're still reducing the purchasing power, the actual amount of money that you have.
Yeah, and importantly, we live in in a way, and I've said this before, in the most difficult time to invest that I've ever seen. And the reason for that is, yes, stocks have more volatility risk. They go up and down, and bonds stay pretty steady from day to day. But you have to take into account not only the risk, but the return. And the return on stocks, I think, is, I'm close to saying destined to, but I won't go that far. I'll say highly likely with a 7% expectation, which could be right or wrong, but it's certainly very likely to be to 2.5%, almost certainty for bonds. And actually, I'm being generous to bonds because the government bond, the 10-year Treasury, is yielding 1.6% today is all. So you got to take a little bit of risk in corporates, and I would frankly take a bigger risk in corporates. But so ask yourself this question, which is riskier for the next 10 years? That bond, which will give you a low return, but probably not very much, or the stocks, which are highly likely to give you a high return, but with volatility along the way. And for that reason, I like the idea of a balanced portfolio, some stocks and some bonds, although you have to think about it a little bit differently today with interest rates at these floor price. Money market funds are basically not even worth buying. The average yield of a money market fund is, I think, 0.2%. People should buy very short-term bond funds, my opinion, high-quality short-term bond funds instead. So there are ways to do it, but you have to look at just not volatility risk, but the entire picture of investment risk to dividend income, risk to your income. If you're giving up a 2.5%, 2% stock yield and getting only 1% from a CD or whatever it might be. And this last 50% decline, one of, I think, 4 I've experienced, they're all different. That's one really important thing. Don't say I've seen all this before. Very few times has the same thing happened twice, and in the financial markets, the same problems happen twice. Yeah, each one is its own. There's some statement like, all happy families are alike, and all unhappy families are different, but all unhappy families are alike in their own way, or something like that. Yep. And the problem here is that all these bear markets are very, very different, inspired by different things, sometimes mathematics, sometimes investors' emotions, and sometimes by external factors. I use that to portray the difference between passive index investing and actively managed fund investing. The Hedgehog, the saying from Archilochus, Greek philosopher who just left a few fragments of his work, was the fox knows many things, but the hedgehog knows one great thing. And what the hedgehog knows is that all this fooling around out there does you no good at all. Own the market. It's another way of saying that. And the fox, oh my, are they smart. They're smarter than all the hedgehogs put together. Go down to Wall Street and talk at all that immensely wealthy brain power that, of course, builds nothing because they're competing with other brain power. I'm not saying brain power is wasted. I'm saying the average brainiac is average compared to the other brainiacs. So they can't win. We know that. So, all the secrets. I've got a tip for you. Just buy this, sell that. That's the fox thing, the foxy way to beat the market. Doesn't work.
And the less sexy index funds outperforming the more active brainiac funds.
The index fund, in fact, is an act of extreme boredom. And if you don't peek, another one of my rules that I'm not sure I mentioned in the book, if you don't look, that's in your interest not to look. Why open that 401k statement or your IRA statement every quarter and say either I'm rich or I'm ruined? Just throw it in the wastebasket. Picking stocks or funds, finding that elusive needle that will give you what you think you want in the future is very difficult. We all know the metaphor of finding a needle in a haystack. It means forget it, it's not worth trying. And I would argue the same thing here. Own the haystack means own the entire U.S. stock market or the entire world stock market. Everybody has different ideas about that. And don't do anything once you get the haystack. No more looking for needles. So it's Don Quixote had it just right. First, let me differentiate between the active managers, let's call him a stock picker. And for each good stock picker, of course, there's a bad stock picker, but no way around these things. And then there's asset allocation. How much do you want in stocks and how much do you want in bonds? To me, that is by and large a buy and hold proposition. Don't do something, just stand there, almost no matter what happens, and maybe no matter what happens. For example, even this 50% decline. You ended up with more money 7 years later, from 2007 to 2014, if you just stayed in and just taken your lumps, and it came back if you were in an all market index fund. So asset allocation is a little different, but there's one thing that is the same. Please don't let anybody forget this. If you're smart enough to reduce your allocation to stocks and increase your allocation to bonds, somebody else is reducing their allocation to bonds and increasing their allocation to stocks.
The logic is the same.
And the logic is identical. So if the system is roughly, which it is, depending on how you count the Treasury's debt, which is another interesting story, but roughly a 60-40 situation. So you have the total market allocation for the typical investor, and the variations are not huge. Somebody's going to be 100% in equities, which by definition is the best long-term strategy, and yet you may not be able to handle the bumps. Well, let me correct myself. No, 100% equities is not the best long strategy. 100% equities leveraged, 2 to 1,
There you go.
3 to 1, just so long as you get someone to bail you out at the bottom,
Right.
and you can pay them back later. This is not an easy thing to do, but we all know those fundamentals, and we all know the allocation for the system is fixed for all of us. So we're trading back and forth with one another, trying to prove we're smarter. And I'd say this about Warren. When he's, as everybody knows, decided to, in the money he's leaving to his widow in a trust, he has directed it to be invested 90% in the S&P 500 index fund. Not a bad Vanguard S&P 500 index fund, I should say, because he said it too. And this big bet he has with a hedge fund, which he's winning by a huge amount happily. They're kind of random events. His bet, his side of the bet, is not that Berkshire will do better than the hedge fund, but that the S&P 500 will do better. So he's a huge supporter, and has been for as long as I've known him, of the index fund. And indeed, when I talked to him about Little Book of Common Sense Investing, I said, I'm going to write in the conclusion. I was just working on the book when I had dinner with him. I guess that would be back in around 2006. And I said, I'd concluded that Benjamin Graham would be an indexer. Do you think that's fair? And because everything changed. Benjamin Graham recanted a lot of, it's hard to find value anymore. There are too many people looking for it. And he said, of course he was an indexer fund. I know because he told me so. And that was good enough for me, so I put it in the book. But so these are the verities of investing, that you're going to depart from this universe of stocks and bonds. If you depart, somebody else does the exact opposite thing. It's a closed universe. And so in that sense, and I love this point, it's a little bit difficult to do without a chart, but the chart is entitled, We're All Indexers. Look at the total stock market. That's what we all own. Now slice about a third of that out, and those are indexers who know the value of indexing. So they own an index fund, and with no trading, arguably no trading. Then look at the other 2/3. Those people own the market index by definition, those stockholders. But they're not satisfied with that. They want to bet against each other, and therefore they lose to the index by the amount of transaction costs they have. None of this is complicated. Warren wrote this great piece, which I edited a little bit, for my book, Little Book of Common Sense, about the Gottrocks family.
Yep.
And they were fine as long as they kept to their own devices.
Great.
But when they started thinking they could beat each other, then they started to do worse. And the costs went up, and the taxes went up. And they did worse and worse until they went back to just buy and hold and don't fight over this with each other. These are verities. Get costs out of the equation. I mentioned to you the magic of compounding returns over the long term, the mathematical magic of it. The problem we have in our society is that that magic, on the record, is overwhelmed by the tyranny of compounding long-term costs. And I gave you that example of 7% gross return, net return, 9% gross return, and it's cost you 70% of your capital over your lifetime. Be aware of that.
Investors don't necessarily need international stocks to have a globally diversified portfolio. But you, yesterday at the conference, you talked about Jason Zweig's good piece on the perhaps relative undervaluation of foreign stocks. Do you think investors ought to look at that, be thinking about the fact that we have not seen foreign stocks perform as well as U.S.?
I guess the answer to that is yes and no. And number one, the fact that they're undervalued may mean that they're undervalued because they're riskier, which I think is at least importantly the case, maybe not the entire case. Second, I'm just a great believer in a U.S. portfolio because we're the most entrepreneurial nation. We've got the soundest institutions, financial and otherwise, or have had in the past. Governance is pretty solid, in the past at least, and a well-diversified economy. And for U.S. corporations, about half of their revenues and half of their earnings come from abroad anyway. Mm-hmm. It's not as if we're America first or America only. The entire world economy is integrated around many, many countries trading with many, many other countries. So I do not think you need to have international. Now, people have been doing it for a long time. The cash flows in the fund business have been much stronger in non-US
international, yeah,
than in the U.S., despite the inferior performance. And I don't quite understand where this thing is that you must have a global portfolio. Maybe it's right, of course, maybe anything's right. But I think the argument favors the domestic U.S. portfolio. And then you have to worry about whether the dollar is strong or weak.
Right.
One more risk. Or many of these foreign nations have, particularly emerging market nations, which are, I think, around 20% of the non-U.S. index, are very risky, very interest rate sensitive, governmentally not strong, or maybe a little capable of tipping over rather easily. So I do tell people, feel free to disagree with me because I'm not always right. But if you I have 0% in non-U.S. I say you don't need to have non-U.S. But if you do, limit it to 20%. A lot of portfolios now have 25, 35, 45% in non-U.S. securities. And I think that's just too much. Buy right means diversify, diversify, diversify in an index fund, which is a great way to invest for reasons I've talked about earlier. You at low cost and all that, but you're diversified, so the intricate ins and outs of the market, steel stocks are doing better, or energy stocks are doing better, or healthcare is doing better, or technology is doing better. If you own the whole market, you get your share of all of that. So, but that's the buy right, very diversified. And the hold tight is what we've talked a little bit about, and that is, when you get these periods of adversity and fear and greed, don't do anything.